All right. Welcome back to another video of Raindrops Finance, where we're going to talk about today's stocks on the fundamental level. We're going to review like what a stock is, how it works, risk reward, how we consider it, and yeah, just try to really deep dive today. I don't want to get into the other side of the stock analysis, which is technical, which we'll do next week. This week, I'm just going to focus on everything with the numbers. That's basically what we mean when we say fundamental analysis. We, the entire world, I guess. So yeah, that's how it works. Right. And so I'm going to go ahead and start with reviewing three companies: Apple, Nvidia, and AT&T. And basically, I just felt like these were three perfect companies. Maybe Apple and Nvidia, I could have chose someone else, like more industrial, but that's what I have. Apple, I think, is still the greatest company, even though Nvidia is fighting for it now to be the most valuable company in the world. Apple's been proven. I think it's one of the safest investments you can make stock-wise. And even at today's prices, even though I do know it's very high, we'll look at this, but overall, Apple's great. So that's why I want to pick them first. I think they're going to be fundamentally sound still, even if some of their ratios are higher than you want to look at or use for your investing needs. But basically, that's what I want to look at today. So without further ado, let's get into it, right? So what is a common stock? Common stock is ownership or equity in a company. And uh, I don't think it can be said any more simple, honestly. That's what it is. It's like just this little piece of paper back in the day. Now we have electronic slips, numbers, basically, and you get to own a piece of company. So for $224.31, you get to own a share or a piece of common stock in Apple. And so it makes you a voting member. In most cases, when you own common stock, you get to vote on some of the things that happen within the company. It might not matter, just like other votes might not matter. But, that's essentially what it is. You're trying to buy a piece of a company that you think is going to do really well so that your money can grow and you can reap the profits or the earnings that these companies make. And they're traded every day on the New York Stock Exchange. They all have tickers, which are letters, pretty much in every case. I don't think that we ever see numbers, but just going to hedge a little. You're always going to see some kind of combination of letters. Every single thing has some kind of ticker or four-letter symbol to let you know that's what you're going to use if you want to trade it. And I'm not going to do the trades on here, so I'm not going to get into like the market orders and things like that, but I might do it next week. I just need to look at a platform that is better. So basically what you do is you buy a piece of company, $224.31 for a piece of Apple right now. And so that means that you would reap any earnings that they get for each shareholder. And I'm just going to break down some of the numbers. This stuff I don't want to get too into, but like the open is just the price that it opened at 9:30 this morning, Eastern time when the market opened, and the previous day's close, which was at 4 p.m. Eastern on Thursday. Well, it closed at $224.18. Just a note here, the price is going to change overnight because there's deals that happen after market and pre-market, which also goes after market's going to be from 4 to 8 p.m. and then pre-market, you should probably Google it. I think it's like 5:30 a.m. to 9:30, but I don't know. I'm not going to look it up. So that's when the market's going to be able to, that's when you're going to be able to buy that. Every day it's going to just jump up and down. Any stock exchange pretty much will trade Apple in America. NASDAQ, New York Stock Exchange. Those are not really important pieces. Equity summary score. I don't know why this isn't on here. They usually have like bullish ratings. Maybe it's just late. But price to earnings ratio, and I'll get into it more when we look at the financial statements about like what the earnings actually are. But the price to earnings means for every dollar that you spend, you get that much in $1 of earnings. So for the case of Apple, for every $34.86 that you spend, you get to earn $1 in Apple's earnings. And over time, you think that you're going to get that money back pretty easily, and that's why you're willing to pay that ratio. So basically, Apple earns, the price is basically $224.18 divided by $34.86 is how much they earned in the year. And you will see that later. It's going to be like $6 and some change. Anyways, options, we will get into that much later. I'm happy to talk about it. Definitely the most riskiest thing, and that's why we're going to save it till the end. But that's going to be what we do in the probably last or second to last video, maybe crypto right behind it. Current dividend X date. So if you own a share of a company, some companies pay out dividends from their earnings. We'll talk about earnings in the financial statement. We'll see the dividend payout as well. But basically what that means is every quarter, usually some companies pay monthly. You'll see it in like real estate more often, like REITs, are going to pay out a ratio of their earnings to the investors. And then the rest of the money they take and they put it back into the business and they try to grow it. And so you have to decide what do you want more? And we'll see that kind of when I look at AT&T, the price is going to be reflected from each earnings payout. Like every time you pay out dividends, the price is going to go down a little bit. You might not necessarily see it, just like you don't see inflation every day, but that money is going away because you are paying it out to your investors. The company is paying it out to their investors, and so they are losing that value on their total market cap, which we'll see in just a second what that means. But basically every year Apple pays 25 cents a quarter, every 3 months, which is 0.44% of the price that you're currently paying. That's what the yield is. You just take whatever the total value is and then divide it. So you might and you're breaking this down. So realistically, you're making 0.11% every quarter in a dividend payment. Apple stock has proven very well. I'll go ahead and pull that, just show them off. They can do their own talking. They've split probably, oh my goodness, so many times. Let's not get into it just yet, but their price has been speaks for themselves in other ways in which you're going to earn money. So you get your dividend payment, you get to secure some income right away, and that's why people like dividends. But you also get to hold that stock and hope that it increases in value, or unrealized gains, capital gains is what you would consider that part of your income. So the sector in which they're in, this is important to kind of look at diversity. You want to have 25 different stocks if this is the route that you choose, like trying to make your whole portfolio. That's how I built Rainwater Wealth Management. The fund is built off of 25 or more investments so that you lose systematic risk. Basically, if something fails within the system, your portfolio should still be intact. Anywho, and then you look at the market cap. So the market cap is the total value of the company. And the way you find this is shares outstanding times the price is the market cap. So every day, and this is what the value of the company is. They are saying that Apple is worth $3.44 trillion. So one of the largest companies in the world. they're right there with Microsoft and Nvidia. It's whatever, they're all right at the top. The indexes in which they're on, so Apple is on every index. These are just the major benchmarks in which we use to gauge the performance of the stock market. Oh, how's the stock market doing? S&P 500's up or down? That's what they're talking about. Dow Jones Industrial Average, NASDAQ 100. Primary exchange, NASDAQ. Like I said, it could be New York Stock Exchange. Doesn't matter. And it's common stock, and QSIP is just the identifier, just like the ticker QSIP identifiers. We see the price of Apple over the time band. This chart we'll get into later. This is volume, and this is price. And we'll learn technical analysis later on. But I just wanted to show the splits of Apple. This is just in 10 years. You can do max. Sorry. This is what you want to see. Over the lifetime, they've split 5 times. So basically what this means is that the company is creating more, they're creating more shares, and they're decreasing the value per share so more people could invest. Used to, you couldn't buy half shares, partial shares. So they were creating more shares, and over time, basically you've built up, you started in the 1980s, you're a millionaire, you don't worry about it, but you're building up shares over time. You started in 1985, now you have 2, 4, 8. The 7-for-1 split would have put you at 56, and then you ended out with over 200 shares for 1 share of Apple, and that's how a split works. And then the price is still, so even if it was just 1 share for $1, 10 cents in 1985, now it's worth 224 times 200, so like $4,000, right? So that's how splits work. I'm not gonna dive any more into that. Basically, it's just a way in which you kind of change the price, but nothing else matters when you do a split. That's actually one more thing I want to touch on really quick. Nothing else matters when you do a split. It's just creating more shares, but the value doesn't change. That market cap stays the same. Another thing is that price doesn't matter. Especially, like I said, there's partial shares that you can buy now. The price in which you pay has no relevance on the safety of the investment that you're making in a stock. And I'm just talking about on a dollar basis, not on like an intrinsic value price, but just on a dollar basis. If you pay $224 for Apple and you pay $15 for Ford, that does not make Ford a better investment because it's cheaper. It just means that you have, less, first of all, like you put in less money, right? So don't think that Ford's like a better deal or anything, because you're getting what you pay for, but also it's just about the gains in your money. So if you invest $200, it doesn't matter how you invest it. It's only about the returns percentage-wise. That's the only way you should think about it mathematically. Perfect. And we're moving on. Not going to get into short interest because I'm not an expert at it. Roaring Kitty, he is. Check him out. That's how I learned about it. That's how I learned about short interest. I wish I would have understood it sooner. But basically, this is just like who's betting against the market. And the percentage isn't like total shares. I think it's a rotational thing. Not even going to get into it anymore. News, profile, events, price performance. This is just like how, the percentage of returns that you can see from this date, and then you'd go back 3-6 months in time. Year to date, the only thing that's kind of like weird here is year to date, you just start from January 1st to now. I don't even, so that's it there. And the only thing else I'm going to look at here, I'm not going to get into statistics too much. Like we could look at like price to book, things like that. They're just different valuation methods. That's what people use to say like, oh, this is a good deal based on like the revenues to what I'm paying in price, or the book value, which is an accounting standpoint on the price. So I'm not going to talk about that. Earnings are important. Dividends I will do really quick as well. Might only do one stock, I guess. We won't worry about AT&T and Nvidia. So earnings per share, this is just how much money they make per quarter. So if you own 1 share of Apple, basically you are owed this like $1.53, and Apple's going to pay you 11 cents of it, and then they're going to pay you, and then they're going to put the rest back in the company and hope that it grows the company in value, and that's how you reap your benefits. And then we use ratios. So based on the earnings that they have, how much is that price? And the earnings comes from an accounting, like basically how much did they make, but after all of their expenses and write-offs, deductions, things like that. The dividend amount is 25 cents. Is that not? Yeah, it's quarterly. So that's the quarterly amount. Announcement date, they're just going to let you know. So this is just when they say how much the amount is. It's just like a confirmation time, just in case like it does change. The ex-div date is you have to own. Now day trade, its settlement is just trade date +1. I actually don't know the rule specifically on this for the record date, but I'm just going to play it safe, not Googling it, and say that you have to own it. Like you need to buy it on the ex-div date now, since it's only one trade date, ex-div date. If you buy it on the ex-div date, it'll settle on the record date, and they'll pay you on the pay date, which is May 16th. But if you own it if you bought it on May 13th, you wouldn't go on record because the day after is your settlement day. That's how the stock exchange looks at it. So the day after is settlement, and you wouldn't be owed that dividend. And so that's just an important standpoint right there on the dividends part. Fundamental analysis. These are just, I don't know exactly how they find these valuations, like Fidelity, but it's just basically categories. They define them, but not going to get into it. Statistics, they just have different ratios. It's neat to look at. Ownership and insiders, this is neat because you see like institutions own 39% of Apple, 38% is owned by other. I don't know who those are. Maybe people. So that's kind of cool. But basically just have breakdown of like who owns everything. When institutions own a stock, they're much easier to like all jump out of it, and it could really change the price. So just kind of more vulnerable to things like that. And the financial statements, gonna do them really quick, 20-minute video. That's why I only did stocks. So you have 3 financial statements: balance sheet, income statement, cash flow. Not really good at cash flow statements. Don't tell my accounting professor. And they're numbers, but they all have like relevance. Cash and short-term investments. It's all values. I can't break it down the whole thing. I'd have to just do like a video about it. But basically, this is just going to be how much the company's making currently, how much it is total is the assets. Liabilities is how much it's paying. So the current liabilities and total liabilities, like long-term debt, bonds, things like that. That's mostly what you see in long-term debt. It just means like bonds, bank loans, essentially. And then equity. So like how much of common shareholders' stock is common equity. Yeah, essentially. How much do they owe to like the shareholders? I might have messed that explanation up, but and then let's see. These are funds in that hold Apple, so kind of neat, like a very heavily targeted Apple fund, something that's like not fully diverse. You don't have to just put all your money in Apple. You could buy it in an index. Okay, income statement is where we see earnings though. So how much is the company making? See progress, the sales, gross profit after cost of goods sold, all this stuff. And you can see, I mean, I'm not going to go through each number, but the net income is the total money that they made. So this means that in the last quarter, Apple profited $23 billion. Shit ton of money. Sorry for cussing. But earnings, and that's where you get your earnings per share. If you broke down how many shares outstanding there are versus the net income, you get $1.53. And the dilution part, I don't completely understand. That's like a weird thing. Not weird, but it's just a little bit complicated in accounting. So that's how you look at earnings per share, though. You see that Apple's, they had a really great quarter before, right? Christmas. So that's That's just a breakdown of how much money they're making. And over the last year, it's like over $100 billion almost. It's right there at it. So it's crazy. And then the cash flow is also going to be crazy numbers. And it's just saying like where they're spending their money and where they're getting their money from. So, and you always just carry forward. Like, you see how much money they made? Well, it was 23 billion. And then this is from all operations. And then this is how it broke down. I don't know why this looks like this though. Fidelity is kind of glitching on me. And that's a full stock lesson for today. I probably didn't even cover everything, but that's like a pretty great overview. Maybe I'll have more time next week, but thanks so much. Take care.